This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
So in the last chapter, we went through and had a look at our standards that dealt with non-current assets. So the focus there with the non-current assets being on our tangible non-current assets. So property, plant and equipment, and then the associated standards alongside that. So looking at, was it borrowing costs, government grants, and investment property. However, when we look at our non-current assets overall, it's not just our tangible non-current assets, so property, plant and equipment that appears on the face of the statement of financial position. We've also got to go through and consider our intangible assets. Again, the standard that goes through and covers intangibles is IS 38, but don't worry too much about the accounting standard number. The emphasis within your financial reporting exam is all about the knowledge and the application of that knowledge. You have very briefly seen intangible assets within the financial accounting syllabus, but it's probably a little bit vague, a little bit hazy, and you don't really see it all that much. You'd have been lucky, maybe unlucky, if you got one question upon it, one small multiple choice question. Here, what we need to be able to do is advance things from financial accounting when it was just literally testing the knowledge. Here, we need to advance it in terms of testing it with the application and the crunching of the numbers. So what will be the carrying value that appears on the face of the financial statement? What expenses do we go through there and see through the statement of profit or loss? Is there any amortization? Is there any impairment? So let's go through. Before we start playing around with the numbers and getting into the nitty gritty of it, let's have a look at what an intangible asset is and what views the standard takes in terms of recognizing an intangible on the face of the financial statements. Okay, so key bit about your intangibles, first of all, is that it has no physical substance. Okay, that's the big distinction, isn't it, between tangible and intangible. Tangible, or your property, plant and equipment, has physical substance, whereby an intangible is just something that's been generated through contract or just being devised in someone's head, okay, in terms of creating an idea that can then bring economic benefit in the future for the business. Okay, so things that we're looking at there, as it mentions, patents, brand names, licenses. If you go through there and think about a patent is the right over an idea. So therefore, nobody else can copy that idea. So if you've got a brand new piece of technology in a car, in a mobile phone, in a vacuum cleaner, to use Dyson as an example, you will have the patent over that idea. Okay, so when Dyson first invented the bagless vacuum cleaner, they had the patent over that, and therefore nobody else is able to copy that idea. Brand names, that's the brand that is associated with the product that you buy. So you may have sports clothing or sports shoes made by Adidas or Nike. You may have other fashionable clothing such as Louis Vuitton, Gucci. You probably got a laptop or some form of mobile device that you're watching this lecture on now. You've got the brand names there in terms of Apple, Samsung, Microsoft, you name it. Okay, and then you've got a license. A license goes through there and allows you to distribute and print material for a specific period of time. If you have that license, then nobody else will be able to go through there and reprint that material. Only you will get the benefits from it. Okay. So they're just a couple of examples. You know, they don't have any physical substance. You can't touch the patent. The brand name just exists as an idea. The license, the same. Okay, it's just a license there that's been signed contractually on a piece of paper. There's no physical substance to the asset that you own. Okay, but when we're going through and looking at it from a specific IS 38 perspective, we have to look at three factors to consider to determine whether or not we can recognize that intangible on the face of the financial statements. So we need to look there, first of all, at the identifiability criterion. We also need to ensure that we have control, and then we also need to go through there and look at the recognition criteria from the framework. Okay. So in terms of identifiability, obviously we need to make sure that it has no physical substance, but in order for it to become an intangible asset under IS 38, you need to be able to sell that intangible separately from the rest of the business. So if you're going through there and thinking about a patent, you have the patent, the right to that idea over a period of time. You can sell that patent on to somebody else without having to sell the entire business. Okay, so a patent is identifiable. Likewise, a license, you could go through there and sell that license separately and continue on with the rest of your business. Okay, similarly, a brand name would be identifiable. You could go through there and sell separately that brand name to somebody else and then continue to go through there and work the business on a day-to-day basis. Okay. We also need to have control. So this comes back down, if you like, to the definition of an asset. The definition of an asset is a resource that is controlled by an entity as a result of a past event that gives rise to future economic benefits. So this focus here on control is saying that only you are able to get those benefits, or you are able to prevent other people from getting those benefits, which is what happens with a patent or a license, doesn't it? You control the use of that idea under a patent. You control the publishing of that material under a license, and you are preventing other people from getting it. Okay. So if it is identifiable, if you can control it, then it's looking like there is the potential to recognize an intangible under IS 38. But the key is here, isn't it? Going back to the framework and looking there at the recognition criteria. Here's a test early in the chapter. What's the recognition criteria for an asset, or the recognition criteria in general within the ISB framework? We did it way back in that very, very, very first chapter. Can you remember back that far? There was 2 recognition criteria. Yep, brilliant. That's one. One is that there were probable future economic benefits. What was the other one? Yeah, brilliant. We can go through there and measure the cost of the asset reliably. Okay. So is it more likely than not that you're going to generate those benefits? Well, with a patent and with a license, yes. Okay. Because you wouldn't have acquired the patent or acquired the license if you weren't going to get benefits from it. And then in terms of the reliability of the measurement criterion, that's where the brand name falls down. Okay. And it leads to us not recognizing brand names within our financial statements, because what's the value of the Adidas brand? What's the value of Nike's brand? What's the value of Apple's, Microsoft's brand? Can you come up with a reliable estimate? I think you might struggle. Okay, you can look at, yeah, there are businesses that value brands. They exist. You go through and look at the different businesses that value the different brands, and you'll find that each of them comes up with totally different brand values. So therefore, that's not a reliable measurement. So from an IS 38 perspective, although a brand name is an intangible as sorts, in that it goes through there and is there as having no physical substance, it's identifiable, we have control over that brand, the likelihood is that it will bring us benefits in the future. We cannot measure it, so therefore it is not recognized. Okay, so if ever you've got an intangible, always come back to the fundamentals of what's contained within IS 38 and within the framework. But what IS 38 does is it gives you some specific rules to follow for certain intangibles. Okay, so the first one that we've got there is if you go out and acquire an intangible separately. So if you go out there and purchase a patent, you go out there and purchase a license. That separate acquisition, how do we deal with that as an intangible within the standard? Well, it's very much like the acquisition of property, plant and equipment, because what you go through and do there is you capitalize at cost plus any directly attributable costs. So are there any legal fees in terms of making that patent legally secure? Are there any testing costs that might be that you've incurred in regards to generating that idea and that patent? Okay, so that there will be separately acquired, capitalized at cost and any directly attributable costs, and then you will amortize that asset over its useful life, because a patent and a license will normally last for a finite period of time, so therefore we will amortize it. And the key bit there is that you amortize it when it is available for use, again at the earliest possible date. We don't go through there and amortize it when it is physically being used. It's there when it is available for use, very similar to what we had when we went through and charged depreciation. The other situation that you've got there within the standard is also looking at research and development. All these big pharmaceutical businesses that you have around the world are looking to develop the latest drug to cure some form of previously non-curable disease. Okay, there's billions of pounds that are spent in research. There's billions of pounds that are then spent on the development from the ideas that have been generated from that research. The key issue that we have here is that we're looking to develop an intangible asset, because we're going to have the fact that it is identifiable, because you could sell on the research findings and the development of that product. You control that product because it's only you who's come up with the idea. Nobody else knows about what you have developed. You're looking to try and get probable future economic benefits and then measure it reliably. Okay, so this is where we need some specific rules that cover research and that cover development. Okay, because they're two different things. Research effectively is scientists playing around for science's sake. Okay, looking for a cure for a cancer. They've got test tubes and they're pouring one test tube into the other on a regular basis, allowing it to settle, seeing if it reacts in a particular way. That's all research. Okay, development is when one day they have that eureka moment. I found it, whereby the test tube and the mixtures or the mixture that fizzes. Okay, something happens. It says, right, we've got this cure. We can now go through and spend more money, and therefore that will then become development expenditure, because we're going to specifically target this finding to develop this drug. Okay, so what we need to do now is look at the accounting treatment. It's quite simple in terms of the research expenditure, because research expenditure is always charged immediately to profit or loss. It can never ever be capitalized. It's too far removed from the finished product, the finished developed drug. And therefore, if it's too far removed from the final drug, are we going to get probable future economic benefits? We don't know. So if there are no probable future economic benefits, then it falls down there, doesn't it, in terms of those recognition criteria as one of the factors to consider as part of IAS 38 and your intangible assets. However, if we then move on to the development expenditure, which is when we take our research findings and then we move into the development phase, whereby we are now specifically targeting a finished product, then what we go through and do there is that the development costs must be capitalized. Yeah, they have to be capitalized. There's no choice. Like in years gone by, there was a choice of whether you could capitalize it or expense it. We want to ensure that the financial statements are comparable, so therefore all development costs must be capitalized. but we can only capitalize the development costs when we meet all of the criteria. Okay, and effectively the criteria will go through there and demonstrate that there are probable future economic benefits. Okay, that we are going to go through there and actually complete the development phase, develop this drug, and then go on to be able to sell that drug and generate the future economic benefits. Okay, so what we've got is that there are 6 criteria. You might go through that and see at the bottom here that there are 2 requirements that effectively come back to look at what we see within the framework. Okay, we can measure the cost reliably, which we should be able to do because we know the amount of money that we're spending on a monthly basis, and is there probable future economic benefit. Okay, now that's whereby you then have these more tailored, specific 4 points that come from IS 38 to show that we are going to get probable future economic benefits. Okay, that we are going to complete it to generate those benefits. So what we've got there is that we are expected to either sell the idea on at the end or use it ourselves. The idea needs to be commercially viable. So it's not just some far-flung crazy idea that isn't, 1, going to work, and 2, isn't going to be able to be used. It needs to be technically feasible. So have we got the technical know-how? Have we got the technical competence to be able to go through there and complete it? And then also, do you have the resources? So do you have the personnel? Do you have the financial resources to be able to go through there and complete it? Okay. So you've got those 6 areas there. Oh, it's difficult to remember those 6, isn't it? So let's come up with a mnemonic. I've heard all sorts of mnemonics in the past from different tuition providers. I think I've heard pirate. I think I've heard sector. Okay. You can choose. The one that I've but have begun to use is this one. Trump CV. Okay. There we go. What have we got? Well, the T is that it needs to be, is it technically feasible? R is that you have the resources. U is that we are able to use it or then to be able to sell it. M is to be able to measure it reliably. P is that there is probable future economic benefit. And then CV, is it commercially viable? Okay, so there we have it. Trump CV. Let's not go there and start talking about anything political, shall we? Okay, Trump CV. There we go. If you can remember that mnemonic, you'll then be able to go through there and remember when we go through there and capitalize those development costs. If we're in the development phase and we don't meet one of those costs, or sorry, one of those criteria, then the development costs will be expensed until we meet them all. Okay, but we very rarely see that at this level in financial reporting. It tends to be that we move from the research directly into the development phase, having met all of those costs. Okay, sorry, criteria. The final bit before in the next video we go through and look at some of the examples. You've also got internally generated intangibles. So here, your examples there are your brands, the mastheads. The key bit there about your brands and mastheads is that they cannot ever be capitalized in the individual company accounts. Okay. The idea there is that, you know, if you're spending money on a brand, you're spending money on a masthead. Yes, you know that you can measure the cost reliably on the expenditure that you are currently incurring. So you think, well, yeah, it's on an intangible, so therefore I'll capitalize it. But it's like, Is that money that you're spending specifically on the brand? Is it specifically on the masthead? So that title that you have on your magazine or the title that you have on a newspaper, okay? You're actually spending money on just the overall business and trying to improve the fortunes of the overall business. So therefore, we can't really separate that expenditure out from the expenditure on the overall business itself. So therefore, we cannot capitalize it. Okay, so whenever you see expenditure on brands, expenditures on mastheads, that cannot be capitalized within the individual company accounts. We see a little twist on that later on when we get to the group accounts, whereby if the parent is acquiring a subsidiary and there is a brand that is not recognized within the individual subsidiaries accounts, following on from what you've seen there. But when you're preparing the group accounts, you can actually recognize that brand if you can measure the fair value under IFRS 3. But maybe just a little bit too far for now. Okay, remember in the individual accounts under IAS 38, a brand cannot be capitalized, but there is potential under IFRS 3 to capitalize that brand in the group accounts if it has a fair value. But we'll save that detail for another day. For now, I'd just like you to make sure that you're happy with the rules under IAS 38 before we go through there and apply them in the next video in a moment. See you shortly.